we'll continue with rules for double entry. So the first rule says double entry means that every transaction affects two things. So it means that whenever we make a transaction, two things must occur. That means you are taking from one side to the other side, or you are taking from that side to another side. So we have to record our transaction twice. That is what it means that whenever you have to do that recording, it has to be done twice, because any transaction involves two sides, the debit side and the credit side. Is it clear?
Yes.
The second one, the order in which you enter items does not matter. You may find it easier to deal with any cash or bank transaction first. However, using the in and out principle, what matters is posting the transaction. That's it. So you could start with bank, you could start with cash. You might feel comfortable posting cash transactions first before bank transactions. It doesn't matter. All in all, you must just ensure that you make your postings and you know which one is going to be debited and which one is going to be credited. The third one, a debit entry is always an asset or an expense. A credit entry is a liability, capital, equity, or income. So what goes to your debit? What are those transactions you have to debit? Transactions that are expenses or assets are always going to be debited. Then those ones that are income, that are equity, liability, or capital will be on the credit side. I think it's clear.
Yes.
So your debit side for every posting should be expenses and assets. Your credit side should be income, liability, assets, or income, liability, capital, or equity. Is it clear?
Yes.
Okay. Now the last one is about, they said to increase or decrease assets, liabilities, or capital, or equity, the double entry rules must be followed. So as a business, sometimes you increase your assets, sometimes you decrease your assets, sometimes you increase your liabilities, sometimes you decrease your liabilities, sometimes you increase your assets by putting more money into the business, or sometimes you reduce the capital by withdrawing from the business. That is drawings. So what do you do? How do you go about these transactions? What items do you credit? What items do you debit? If you have to increase your assets, what items are you going to debit? If you have to decrease your assets, what items do you credit? So for assets, these are resources that belongs to the business. It belongs to the business. Assets, they belongs to the business. So whatever you have in terms of capital, in terms of liabilities, they all work for the business. So they are all assets. Logically, they are all assets because they work for the business, but they have different items and they have different titles. So for assets, how do you increase your assets? So when you are increasing your assets, it means that you are buying more of equipment, you are buying more of motor vehicle, you are getting more of debtors. That means more customers are buying from you without paying, or you are receiving more cash, or you are receiving more check. These are all assets. So your assets will increase if you have a debit entry. Did you get it? So to increase your assets, it has to be what? A debit balance. Did you get the point? We said asset is for the debit side. You have to debit assets. So if you are increasing your assets, it has to be what? Debited. It means more assets are included or added to what you have. So to increase your assets, it has to be a debit entry. Is it clear? So to decrease your assets, if you are decreasing your assets, it means that you are reducing your assets. It might be that you are reducing your asset of cash. It might be that you are reducing your asset of bank. So if you are reducing your asset, it has to be what? A credit entry, because you are reducing it. Maybe you have money in the bank. You have to pay some suppliers. If you are paying some suppliers, your asset of bank will reduce because you are paying them through your bank account. At the same time, your liabilities of creditors will reduce. Those are the two transactions, like I told you earlier. So if you are paying your supplier, your credit supplier, as soon as you pay your credit supplier, your cash or bank assets will reduce. And at the same time, your liability of creditors will also what? Reduce, because you paid some of them. Is it clear? Yes. So to increase your assets, you debit entry. To reduce your assets, you credit entry. Is it clear? The second one, go to the liabilities. What are liabilities? These are debts to the third person or to other businesses, what you are owing other businesses. So how do you increase it? When you are increasing your liabilities, it means you are going to have a credit entry. To increase your liability, it has to be what? A credit entry. That means you are receiving more of debts. It's a credit. Is it clear? And if you are reducing your liabilities, it has to be what? A debit entry. At that point in time, like what I just told you earlier, that you are paying some of your suppliers. If you are paying some of your suppliers, that means it has to be a debit entry for you, for the business. Do you get it? Then it has to be debit entry for that supplier because the supplier will receive cash from you. Do you get it?
Yes.
Okay, great. Then for equity, to increase your equity, it has to be also a credit because it means the business is giving money to, the owner of the business is giving money to the business. And whatever the owner of the business gives to the business in terms of cash does not belong to the business because there's entity. The business is separated from the owner of the business. So whenever the owner of the business puts money into the business, it is called capital. Or whenever investors put money into the business, we call it equity. Do you get it? We can have different shareholders. It is equity because they have to get dividends. You get the point, okay? So to increase your equity or capital, it has to be credit.
Yes.
Then to decrease it, it has to be what? Debit. Because at that point in time, you are paying back the owner of the business or you are paying back those investors. Any question about that? So you have to, I think it's clear. Assets, to increase your asset, you debit. To decrease your asset, you credit. To increase your liabilities, you credit. To decrease your liability, you debit. To increase your equity or capital, you credit. To decrease it, you debit. Is it clear?
Yes.
Any question about that? No. Okay. Then we'll go to accounting equation. For accounting equation, it's a capital that's the owner's money or owner's money equals to assets, cash in hand. So the cash you have at hand is an asset to the business. It is called current assets. And the owner's money, it's capital, or investor's money, it's what? Capital, because it doesn't belong to the business. So if the business then buys inventory of goods and pays for them by cash, the accounting equation will look like this. So we started with asset, capital equals to assets, or asset equals to capital. So capital is the owner, the money the owner of the business has that has put into the business. Now, the business is having that money, that is the cash, which is asset. Do you get the point here? The owner puts cash into the business. It is capital and at the same time assets, because the business will be able to use those cash. So the capital has turned to cash. That is why we say capital equals to assets. It is the owner's money, owners of the business money. It is their money, but he or she has put it into the business, or they have put it into the business. So the capital has become cash for the business. And cash for the business is what? An asset. That is why capital equals to asset. I think it's clear. Mm. Now, if the business now use the cash to buy stocks, inventory, like goods into the business, capital is still equals to asset. But what happens there? This is what happens. Capital will still be asset, but the situation has changed. Now the business is going to have cash and stocks. Do you get the point here? Okay. So if the business now buys stocks, two things have happened. The asset has increased because the business has used some of the money, some of the cash it has to buy stocks. So remember we said when you are increasing your asset, it has to be a debit, right? So asset is still equal, capital is still equals to asset. But what happens with the asset? Asset of cash and asset of stocks. So asset has become two now. Did you get the point? Yes. The first one is that asset is equals to cash, is equals to capital, or capital equals to asset. When the owner of the business puts money into the business has cash now. So the business is, at that point in time, we have one asset, we have capital. But now the business has bought items like stocks, goods, inventory. The asset has increased. It becomes two. We have cash in hand and inventory of goods. Do you get it? Mm. At that point in time, capital is still equals to assets. Any question about that?
No.
Good. Then the third one. So the accounting equation is still capital equals to asset because nothing has changed. The only thing that changed was that we have more assets, which is which includes inventory. Now, if the business incurs a liability, the business has incurred liability, it means that the business has taken maybe a bank loan. So if the business has taken a bank loan, how does the equation looks like? There's capital, there's asset, now there's liability. Because a loan is a liability. It could be a long-term liability or a short-term liability. Liability is liability. So now, because the business has taken a loan, the business liability has increased with a bank loan. So here they said the account, okay, if the business incurs the liability, example given, obtains a loan from the bank, the accounting equation will look like this. Asset equals to capital plus liability, which is still the same as capital equals to asset minus liability. At this point in time, the business asset is still intact. The capital is still there. Now it has included liabilities. So we have to change the accounting equation because we have to separate the capital, the money that belongs to the owner of the business. Asset and liability, the business will sort it. Capital, it's separated. So whatever we have to get in accounting equation, it should be capital equals to. So based on the equation, we have asset equals to capital plus liabilities. We have to collect like terms because we have to make capital the subject. So to make capital the subject here, let's put it on this side, on the left side. So we have minus capital. So minus capital equals to minus assets plus liabilities. At that point in time, we need capital, not minus capital. So how do? We multiply both sides by minus capital. So minus capital multiplied by minus will give us capital. Capital stays. Then minus asset multiplied by minus becomes plus. That means assets. Then minus multiplied by positive liabilities becomes negative liabilities. So that's how we're going to get capital equals to assets minus liabilities.
Yeah.
Do you get it? Okay. Any question about that?
No.
All right. So that is all about that. Then we have a question. They said, in other words, the capital equity always equals to the asset less the liabilities. We said that already here. So we have an example here. They said, I wrote it out. They said, if the business incur, okay, I wrote it out. Okay. So the capital of a business is 10,000. Okay. The business obtained a loan of 5,000. What is now the capital? The capital of the business is 10,000. The business obtains a loan of 5,000. So what is now the capital? Remember we said capital equals to assets minus liabilities, right? Okay. Now the business has taken 10,000. The business has a capital of 10,000, which is equivalent to the cash. Yes or no? So the 10,000 becomes cash here, right? Then a loan of 5,000. A loan of 5,000 is liability, but at the same time is cash because it belongs to the business. The business will be able to use it. So it means 10,000 plus additional 5,000.
Yeah.
Do you get it? Minus the liability. Because we said capital equals to asset minus liability. Here we have two assets now. We have cash of 10,000, cash of loan of 5,000. The owner of the business gave the business money. That is the capital. So capital is separated separately. The capital will become the cash that the business is going to use as assets, cash in hand. At the same time, the business has taken a loan from the bank, which is another cash, which is 5,000. That means the business is having double cash there, 10,000 plus 5,000, which means 15,000. Now, minus the liability. What is the liability of the business? The 5,000 loan taken. So minus 5,000 will give us what? 10,000. So that is the capital. Did you get it? So the formula gives us the same thing now. Capital is what? Assets minus liabilities. Your capital is not going to come from heaven. The asset is not going to come from heaven. It's going to be from the owner of the business. But the owner has noted that there's an entity. The owner is separated from the business. That is why we are calling that capital, that cash, capital. But at the end of the day, liability goes for liability, asset will stay as asset, capital will stay as capital. So the formula for the accounting equation is now what? Capital equals to assets minus liabilities. Any question about it?
No.
So that's the end of rules for double entry.